Lisa thinks Friends, Fans, and Foes of Dad Saves America is cringe.
You've already established it.
She's like, no, stop. No, but, she's my harshest critic. What do you think, Julia? Cringe?
I think it is just slightly cringe, but in the best way. It's good.
Hi there, friends, fans, and foes of Dad Saves America. John Popola here. And I thought I would take this Friday to talk about the Fed. Yes, the Fed, one of my all-time favorite subjects, and perhaps some of yours. The Fed is a love it, hate it, or love to hate it enterprise. And this week, Jerome Powell and the Federal Open Market Committee have done something that they haven't done in a while, which was lower their interest rate target.
Today, the Federal Open Market Committee decided to reduce the degree of policy restraint by lowering our policy interest rate by a 0.5 percentage point.
This presentation has none of the hallmarks of modern American politics. There's no psychosis in the room. And I think we should be grateful for that, but I think it also hides some of the dark and nefarious things that end up going into our monetary system. But before we get into some of the dark and nefarious things, I thought I would share a very bright, light, happy explanation of the way the Fed actually works, provided by the Fed itself. Warning, this music is an earworm that may wreck your weekend.
Hi, I'm Susan.
And I'm Ronnie, and we work for the Federal Reserve.
I can't help but just imagine them taking their masks off and revealing lizard people.
The Central Bank of the United States. The Federal Reserve, or the Fed, performs 5 key functions to help promote a healthy economy for all Americans. One of those functions is conducting the nation's monetary policy.
What is monetary policy? It's what the Federal Reserve does to accomplish 2 goals mandated by the U.S. Congress. Promoting maximum employment, which means that all Americans that want to work are gainfully employed, and promoting stable prices for the goods and services we all purchase. In this way, the Fed's monetary policy decisions truly affect the financial lives of all Americans.
I want to linger on that for a second. The dual mandate. Stable prices, which is to say a stable supply of money in relation to the demand for money. So the money that we earn, that dollar that you get in your paycheck, next week, next month, next year, can purchase roughly the same amount of stuff. Ideally a little bit more, in practice a little bit less. And sometimes, as we've seen in the past couple of years, a lot less. So stable prices is the thing that they're actually responsible for. Other piece of the mandate, full employment. That one's weird. And we're going to get to why that's weird. But the notion that the agency that controls the supply of dollars in our economy has control over how many people are working, that gets into some of the reasons why so much of our economy is so screwed up.
Monetary policy decisions are made by the Federal Open Market Committee, or the FOMC. The members of the Federal Reserve's Board of Governors in Washington, D.C., and the presidents of the regional Federal Reserve banks participate in the FOMC meetings.
There's a lot of people out there that say the Fed is a private enterprise, that it is owned by private banks. In a certain sense, this is kind of true in that the Fed works so closely with the financial system and has such a revolving door with the financial system that it is, I think, functionally captured by big finance, by what's often called the broker-dealer banks that they're buying and selling treasuries from all the time. But it's not true that the Fed is a private enterprise. It is a creature born in Jekyll Island, but ultimately birthed by the U.S. Congress, regulated by the U.S. Congress, and the Board of Governors and the chairman of the Fed are appointed by the president with a Senate confirmation. So it is a government agency. It's not a private enterprise. Frankly, I wish it was, although in that case, I'd also hope that it had competitors, because a single private enterprise isn't much better than a government monopoly. But the Fed isn't private, folks. This gets in the way of us understanding why the Fed sucks. There's plenty of reasons to hate the Fed without getting into the murky waters of, oh, the Fed is actually like a crypto private enterprise. It's not.
When necessary, the FOMC changes monetary policy primarily by raising or lowering its target for what's called the federal funds rate, or the interest rate for overnight borrowing for banks.
Lowering that target rate represents an easing of monetary policy that lowers interest rates and boosts other asset prices if the economy is sluggish or inflation is too low.
That's actually a reasonable explanation of what the Fed is. And actually, if you hone in on the way that was explained, it's actually more accurate than what Jerome Powell said at his press conference.
Today, the Federal Open Market Committee decided to reduce the degree of policy restraint by lowering our policy interest rate by a half percentage point.
Here's the thing. The Fed doesn't directly control interest rates. It controls the supply of money. And through its manipulation of the supply of money, which you could also think of as available money to be lent or loanable funds, interest rates in the market go up and down. Money, and specifically money that is available to be borrowed, is a product, is a good like anything else, like apples at the grocery store. The more there is, the lower the price. The less there is, the higher the price. The more demand, the higher the price. The less demand, the lower the price. And so what the Fed does is create and withdraw money from the economy in order to try to change the interest rate that they're paying attention to. That's the target part. Let's take a look at how, our typical news media talks about this. And then I want to get into sort of the underlying problems at the heart of the theories that drive this, including and especially that dual mandate.
The Federal Reserve's first rate reduction in more than 4 years could directly impact the finances of millions of Americans. Jared Bernstein joins us now to discuss. He is the chair of the White House Council of Economic Advisors.
Oh, Jared Bernstein. Some of you may remember the first one of these Friday videos was a reaction to Jared Bernstein, whose understanding of these issues is, let's just go in the Wayback Machine.
Some of the language and concepts are just confusing. I mean, the government definitely prints money, and it definitely lends that money, which is why the government definitely prints money, and then it lends that money by selling bonds. Is that what they do?
No, it's not. Yeah, no. Here's what we've got for now, I guess.
Thanks so much for making time for us today. I want to start right there. Can you talk about how today's decision from the Fed will affect people across this country?
Well, when interest rates are coming down, that means a lot for anybody who's taking out or carrying an auto loan, a mortgage loan, a credit card loan, or for that matter, a small business that wants to invest in the kind of optimism that we see among small businesses.
You hear that? You can invest in optimism. I didn't know that was a thing you could do. Oh, political rhetoric. It's just so stupid. So what is actually going on here? What did the Fed do, and how should we think about it, and how should we understand it? Let's take a step back for a second, because I think it's worth kind of going back to basics in times like these. So what is interest? I'm going to go and buy a car. Let's say a $30,000 car. I don't have $30,000, but I need a car. So I do have an income, but I don't have all the money. Maybe I have a little bit to put down. How am I going to buy a car? Most people don't buy a car cash. They take out a loan, and that loan charges interest. Right now, it's on average around 8%. Well, where'd that money come from? That money came from somebody else who has savings and is looking to put those savings to work and have those savings make them money. So somebody or multiple people have saved that $30,000 that I will borrow from them and give to the Toyota dealer so that they'll give me a Corolla or whatever. So what is happening there? So number one, I am getting to use that money, and the people that saved it are foregoing the use of the money. That's actually the heart of what banks and financial institutions actually do. They are an intermediary between savers and investors. savers in the case of like a car loan, and buyers are consumers. When I've borrowed the money from them, they no longer have the money. They're going to get it back over time, and I've got to pay for that privilege. This cuts to an idea that economists call time preferences, and it's pretty simple. All of us would rather have what we want now, not tomorrow, not 2 years from now, not 10 years from now. The longer we have to wait, the more we want to be compensated for the waiting. And that's what interest is. Interest is paying for the privilege of getting the thing today instead of waiting till tomorrow. The other thing you have to keep in mind is that when you lend your money to someone and they spend it, promising to pay you back over time, they might screw you. That's just a fact. Maybe they crash the car and lose their job, and now they can't afford to pay you back and they default. And so there's a risk of lending someone your money. So if the primary interest rate is about time or the term, another part of your interest is the risk. How likely are you to default? Now, this is why, for example, if you have bad credit, you'll pay higher interest than if you have great credit, because that's lowering the risk premium portion of the interest. The final piece of the puzzle, and this is where the feedback loops get interesting and crazy as it pertains to the Fed, is the fact that in our world, with a central bank that continually prints more and more money every year and more money than we actually need, the value of our money keeps going down. That's inflation. So that dollar that you borrow from me today, if you pay me back $1 in 10 years, it's not going to be worth $1 in purchasing power. It's going to be worth, well, God knows what. Hopefully 80 cents, maybe 30 cents. So that's the inflation premium. You don't want to lose money on the deal just because it's losing value over time because of inflation. And so this is where what the Fed does with interest rates and its easy versus tight money gets pretty complicated. And it actually makes looking at interest rates as the indicator of whether monetary policy is tight and restrictive, as Jerome Powell said, or loose and accommodating, hard. Because low interest rates might mean we have easy money, as in the Fed's printing too much of it and creating such a supply of loanable funds that people can borrow and spend and be reckless and create bubbles and set us up for a crash. It can also mean, however, that people are scared or that the economy has actually gone into recession. Interest rates actually go down during recessions. So what the interest rates actually are right now in the marketplace and in the economy is pretty complicated. So that's the basic way to think about interest rates in reality. How does Fed policy, for us as individuals making those choices, impact all of this? Well, let's go back to the clip.
But can you talk about a time frame? How soon will Americans be able to feel this impact?
Already, because if you look at the mortgage rate, since the markets began predicting that the Fed would lower interest rates as they delivered on today, you have what we call a priced-in effect. That is, some of these rate cuts were priced in before they were made. We have the 30-year fixed-rate mortgage at about 6% right now. That's down from probably around 7.5% where it peaked. Now, we'd like to see it come down more than that, and lowering housing costs is absolutely key to the Biden-Harris agenda. There are costs out there that are still too high for sure, and housing is one of them.
This really cuts to the heart of things. So, of course, politicians and finance people and, people in industries that benefit from cheap credit want interest rates to be low. And all of us that have to borrow money certainly want interest rates to be low. Whether or not that makes our lives more affordable or not is up for grabs, because there is a lot of other forces at work. For example, when money gets easy, we spend a lot more of it on the things that we want. And what we've seen in both housing, with our housing booms and busts, and in higher ed, where the government has stepped in to make loans artificially cheap, what has primarily happened is the cost of those things has actually gone up. You see, because supply and demand works that way. If you pump money into a sector or into the economy as a whole, but let's just focus on housing. If the Fed is printing money in the hopes of getting it in the hands of people that will borrow and spend on assets, as was described here, like cars and housing, what happens, do you think, to the prices of cars and housing? If you aren't producing a lot more houses or increasing the rate of producing houses, the supply of houses, you have increased the demand for housing. So prices are going to go up. That is what we've seen time and time again. The relationship between interest rates and borrowing costs and the cost of living is not remotely as simple as we hear in news clips like this and political figures and politicians and bureaucrats. It's way more complicated. I'm not going to claim to know what interest rates should be. In fact, I don't think it is knowable. I think this is one of the problems with the Fed, is that it's basically a kind of Soviet-style central planner of the price of credit, and they can't know either. But one thing we do know is that the Fed has stated explicitly in its 2020 statements about its policy objectives, which it hasn't gone back on and changed, is that it's aiming for, on average, 2% inflation. You notice something in this graph? Going back to 2022, at no point has inflation gone below 2%. And who knows how accurate these numbers even are. But if these are the numbers they're looking at, which they mostly are, we're currently at 2.5. So we haven't got, I don't know why they're cutting. I know it sounds like it's going to make things easier on all of us who have loans, or should I say, people that need to take out new loans. But that's not crystal clear either. So to come back to the more fundamental question, what's going on here? Why is it so hard to navigate this? And what are the underlying assumptions driving all of these people and the choices they make? Well, it starts with something that I spent a good amount of my life obsessing over in the aftermath of the financial crisis, and that is the economic views of John Maynard Keynes. I made these rap videos about Keynes and his intellectual combatant Friedrich Hayek many years ago. We'll put a link to him down below that's all about this stuff. But at the heart of what John Maynard Keynes did to economics was flip the most basic reality of it on its head. So, what do these people want us to do? Inspired by Keynes, the academic scribbler, as he would say. They want us to spend. They certainly love to spend. In fact, our deficits are at all-time highs, which is another problem, because where are they getting that money? They're borrowing it in the same markets that we have to borrow from. So they're working at cross purposes right from the outset. But fundamentally, what these people want us to do is stay on a treadmill, constantly spending, never accruing savings and building value. They call it the circular flow. Income equals expenditure. Keep it moving. Keep the pedal to the metal. That is not what's happening to build wealth in a society. The way we actually do that is by creating more stuff we actually value, not using it up. So they want us to have more money in our pockets so we can go to the store and use it and spend it and use stuff up. Buy things. This is why these same people in a couple months are going to be talking about how important it is that Christmas stimulates the economy, that buying goods off the shelves is what drives our economy, or 70% of the economy is consumer spending, and so consumers drive the economy. All of that is what drives this policymaking, and all of it is wrong. Because that's not how we get rich. We don't get rich by using stuff up. We don't. And the way the Fed fundamentally works is to try to manipulate us into using stuff up, into spending more, into going into debt. That's part of the reason why inflation's always positive. They always want our money to literally be burning a hole in our pockets. Because they think It all works in a kind of circular flow. The economist that actually came up with the measurement of GDP believed in this model of the economy to such an extent that he actually constructed a pneumatic physical model in an attempt to understand how economies work. Like it's an engine, like it's some kind of machine, but it's not. The problem, very fundamentally in my view, with this hydraulic view of the economy is that it is what economists would say entirely nominal, focused on money, not real, focused on value, focused on quality of life, focused on the things that we actually want to use money for. You see, at the end of the day, wealth isn't money. Money is just a way that we keep track of what we're doing and measure the choices we make. It is a measurement tool. It is a kind of receipt that we earn by contributing value to the society. That's the best way I've ever heard described what money actually is. And this does touch on some things that are personal and that are life lessons. If you want to make more money, and what I mean by that is have each hour of your time empower you to live better, to have more purchasing power per hour worked, to be more productive. That is the best definition of productivity. Doing more with less, especially time. I think we all actually know in different ways how you do that. You have to get better and faster at what you're doing. This is why we invent tools like equipment and computers. That is how we actually grow the economy, not using stuff up. It isn't just buying Christmas presents to play with that makes the economy work and grow. Real growth comes from expanding the pool of value in our society, figuring out ways to do more with less. In a certain sense, having more people that are net contributors to our society, that does grow the economy in the sense that it's more goods and services being produced than consumed. More produced than consumed is the key. More consumed than produced eventually means we don't have anything. So that's the fundamental lie at the heart of all of mainstream economic discourse. It's why every time you hear, I'm going to make things cheaper by having a tax credit or giving a subsidy, all you're doing is moving money around. Giving a tax credit doesn't create more of anything. Now, I want to wrap up with something even more wonky than this, which is the alternative thing the Fed should do before it, in a perfect world, ceases to exist. Because I believe that the best thing we could have to improve our situation from the monetary perspective would be fundamentally to return to something like the classical pre-war gold standard. And the reason for that is what money does or doesn't do in helping us to do that thing that I'm talking about. What role does money have, ideally, in helping us create more value and do so in a better and better way, spending less and less time per value we create? The fundamental thing that money does, fundamentally, is it enables exchange. It is a medium of exchange. So you need a complex supply chain to produce anything remotely complicated. Everything in this room involves lengthy supply chains with millions of different people and skills and materials and design and processes happening over time to have all this, to have this computer, to have this camera and the glass inside the lens and the aperture metal inside of the lens that makes this all happen. Money makes that possible because it enables us to exchange in a massive modern way. When you mess with the money, when you continually change its value, you introduce massive amounts of noise into the signal of information that money represents. So the Fed mucking with everything in the name of manipulating us to spend more money than we should and borrow more money than we should also makes it harder to do the thing that will actually grow the economy for real, which is make choices and trade-offs about how to do more with less. That is why stable money is so important. That's why this thing, the Federal Reserve, which has been focused on, frankly, in the past several years in favor of all manner of nonsense that's not remotely as important as the Fed, should be something you really think about and care about and pay at least some attention to. Finally, so long as we have a Fed, what should it do? Because it's not doing the thing it said it should do, which is try to bring inflation down to around 2% a year on average. It's not even doing that. But what should the Fed do? Well, the school of economists that I think offer us the best way to think about that are called market monetarists. And what they say is all this focus on interest rates and inflation is fundamentally wrong because it doesn't take into account the difference between the money side of the economy and the real side of the economy, the actual making more or less stuff, having more or less growth in the real reality, not the paper reality. The challenge is what we measure is the paper reality. So their advice, which I happen to think is a pretty good way to go, and what I would hope the Fed could move to, is something called nominal income targeting, nominal GDP targeting. That would be that the Fed looks at the actual amount of spending in dollar terms in our economy and tries to keep that essentially stable. So now, what would that actually mean? That would mean, number one, that when we get better at doing things, like let's say AI really does produce this massive revolution and brings down the cost of everything. It actually will bring down the cost of everything. That's what increasing productivity and real growth would do. Our money in our bank accounts in this environment where income is kept stable in dollar terms would actually go up in value in terms of purchasing power. If the robots can suddenly build all kinds of stuff and the stuff they make gets way, way, way cheaper, everyone's purchasing power would go up. That's called deflation, and it's good deflation. Similarly, when the supply of things goes down, prices would go up to let us know that we need to invest in doing more of that, like what happened during the pandemic when the supply chains were completely screwed up by lockdowns. Pumping money in to try to solve a real problem, which is what the Fed did at the time, is what gave us all this horrible inflation in the first place. It didn't solve anything real. It gave us all the pain and all the expensive food and clothing and bacon and eggs that we have today. So the Fed has a lot to answer for in our times. And I wish we as a public and our politicians would spend a lot more time focusing on the reality of it. But before we can do that for real, I think all of us need to do a better job of understanding what money is and how it works. I hope this was helpful. Please let me know what you think in the comments below. I'll put some links to some other resources here because if you're interested in this topic, there's massive rabbit holes you can go down, and I hope you have a great weekend. If you like these videos and want to get even more Dad Saves America and support what we're doing here, I encourage you to go to dadsavеsamerica.com and subscribe. It's our new Substack where you can become a member. We're going to be doing all kinds of other cool stuff like having Zoom calls and answering questions. And it helps us keep making more of these videos and keeping them as high quality as we can make them. So be sure to check it out.